So now in part three of our series on portfolio performance, now comes the fun part. We went through the previous sections, we went through all the pain and suffering to develop our regression model where we look at total return. And now is the time to take four companies, Intel, which we already looked at, Amazon, Bank of America, and American Airlines, and see how they performed over time, and then come to some kind of conclusions. Is this something I want to invest in long term? So in the previous section, we or in part two, we looked at Intel, but we'll review those results here. The graph here is the graph of adjusted share price. Remember, adjusted share price is the actual share price adjusted for dividends and stock splits. And to the right-hand side there, let's look at the second table there. Ex post and ex ante. Ex post means after the fact. Ex ante means before the fact. So our ex post cost of capital is what the regression model told us. We looked at the historical stock prices, adjusted stock prices of Intel, calculated a total return, and that would be the ex post cost of capital. Ex ante cost of capital comes from the table above that, where we calculate the cost of capital based on the risk-free rate of interest, which is the 10-year Treasury, plus the risk premium. And if we, so our ex post cost of capital, what we got from the regression equation is 13.05%. The ex ante cost of capital, which we got from using the risk-free rate and the risk premium, this is what the market would expect, is 11.79, and the ratio is 111%. So that means that Intel performed about 11% better than expected. So if we take a look at the very bottom table, our annual return mean is 13.05%. Our annual return volatility is 42% approximately, and our R squared is 79%. So an R squared of 79% tells us that the model is a pretty good indicator of future performance. So Intel, given that its ex post was 13 versus an ex ante of approximately 12, it did a little better than what the market expected, but it still turned out to be a good investment. And the assumption here is that past performance actually does predict future performance, which is one of those things that anytime you look at an investment perspective, it says the opposite. But in this case, if a company performed well in the past, you would assume that they would perform well in the future, and vice versa. Now we're going to take a look at Amazon. Amazon is one of those companies that did very well. And if you bought Amazon, you're probably a very happy camper. We can take a look at the Amazon adjusted share price in that graph. And we want to take a look at the table called cost of capital. So our ex post cost of capital is what we got from the regression equation. That's approximately 23%. And our ex ante, which is what the market expects, is a little over 9%. So the ratio there is 251%, which means that Amazon performed 151% better than what the market expected. So if we look at the very bottom table, we can see the annual return mean of 23.15%, which is great. Annual return volatility of 50.8%, and the R squared is 92%. So that would indicate that model is a very good predictor of future share price. So we can come to the conclusion that Amazon's actual returns greatly exceeds its cost of capital. So at least in the past, it has been a good investment, and you may or may not want to impute those returns in the past to the future. Now, the returns on Bank of America have been greater than zero, which is always a good thing, but they haven't been stellar. You can see that right around, if you take a look at that graph of adjusted share price, right around the time of the Great Recession or Great Financial Crisis, the share price took a dive. And that makes sense if Bank of America was heavily involved in and the CDO business. They probably had a lot of loan losses, et cetera. So banks always suffer in times of stress, and we can see it there. The ex post cost of capital, this is what we got from the regression equation. So over its history, its stock price history, Bank of America generated a total return of 4.57%. Now, its ex ante cost of capital is what the market expects, and they expected 8.89%. So the ratio there is 51%. So that means that Bank of America in general has performed way worse than what the market expected. The market expected 8.89%. Bank of America actually delivered 4.5%. And we could take a look at the very bottom table. Its annual return mean was 4.5%. The annual return volatility was 37.4%. And now the R squared was only 41%. Remember, the R squared in percentage terms goes from 0 to 100. 41 is may not be the model may whenever an R squared is very low, that basically says that there's some other variables in that regression equation that are not accounted for. Right now, all we have is time. And in the case of Intel and the case of Amazon, the R squareds, just based on that model as a function of time, total return as a function of time, were very good predictors. This one, even though it says that Bank of America was underperformed, the R squared of that model is only 41. So I would take that that return as a grain of, with a grain of salt. So the last company we're going to take a look at is American Airlines. And as you can see from the adjusted stock price graph there, it's on a downtrend, which is not good. One of the things about airlines is there's a lot of fixed cost. And whenever an airline gets into a price war with another airline, it wants to make sure that it'll cover its marginal costs and kind of leave their covering fixed costs to a future date. Which is not a good thing if this continues indefinitely, because you'll never cover your fixed cost, and therefore you'll always basically not perform well financially. One thing that Warren Buffett said, I listened to something that Warren Buffett. He was at Duke University and he was talking to a bunch of students, like at a seminar, and he made he basically posed this situation. Assume that you were a settler in the 1800s, crossing the prairies from the East Coast to the West Coast, and someone stopped you along the way and says, you know what, this journey is extremely dangerous. It's going to take you months to get from one coast to the next. What if I told you that I could create a company that will fly you in the air from the East Coast to the West Coast, and you will never make money owning that company? Obviously, the settler would say, "What are you, nuts? I mean, to condense your time from going for months to in 4 hours. I mean, why wouldn't that company perform?" And one of the reasons why it doesn't perform is because American Airlines, as long as a lot of other airlines and companies of that ilk, they have a lot of fixed cost. So whenever they set pricing, especially if they're in a price war with, say, United Airlines or someone else, they'll set their prices such that they cover their marginal costs, but they'll leave covering their fixed costs to another date, which means they're going to sustain a lot of losses. And this is probably what's happening with American Airlines. If we go to the cost of capital section, we can see that the ex post cost of capital is a negative 13%. Which means that if you held the shares throughout the share price life, you would be recording a stellar return of negative 13, which is not good. Now, the market expects 10.6%, which means you're way underperforming. So if we looked at the very bottom table, the annual return mean was a negative 13%. Return volatility was 42, and the R squared was actually pretty good. Well, what this says is that with an R squared of 71, this regression model, which is a function of time is the only variable. It basically says is that this model is pretty good, and that's what we found with Intel, and we found that with Amazon, that this base regression equation, where adjusted stock price is a function of time, works very well. And it's the same thing with American Airlines, which actually for them is pretty bad because you looking at that R squared, you can look at that regression equation and say, you know what, if I'm holding this thing into the future, chances are it's not going to perform very well. Because it's recorded a 13% negative return with an R squared of 71, which is not good. So given that American Airlines actual return is significantly less than its cost of capital, this has not proved to be a good investment. In fact, it's been a dog. And you might say that going into the future, I'm gonna expect the same, or I'm gonna get the same results, which is not good. So with that, we will conclude our series on portfolio performance. I hope you've enjoyed it. So come join our community. It should be fun. We provide the software, all the calculations, all the historical data, everything that we've discussed in these slides, here and in the future. So come join us.